Hey friends, welcome back to Cheryll Trades Leaps. Today we're talking about something that can literally change your results forever. How to grow a small account with Leaps without chasing quick wins. Because the truth is, small accounts don't fail because they're too small. They fail because people trade them like a lottery ticket. So in this video, I'm going to show you the exact mindset and framework I use with Leaps, step by step, in a way that's easy to understand and realistic. Let's get into it. 1. What Leaps are and why they work first. What are Leaps? Leaps are long-term options, usually 12 to 24 months out, that give you exposure to a stock's upside with less capital than buying 100 shares. But the real reason I love Leaps is this: time is your advantage. Short-dated options fight against time. Every day that passes hurts you. Leaps are different. They give your thesis time to play out. And if you choose deep in the money calls, you get something even better. Higher delta, lower extrinsic value, less sensitivity to option decay drama, and the trade behaves more like shares. So if you're trying to grow a small account responsibly, Leaps can be one of the most capital-efficient tools if you use them correctly. 2. The number one mistake. Small accounts make. The biggest mistake small accounts make is trying to grow fast. They buy weekly calls. They gamble on earnings. They take random trades because they're bored. And the reason this doesn't work is simple. If you lose 30% once, you need a huge gain just to recover. And if you lose 50%, it becomes emotionally hard to keep going. So I want you to hear this clearly. Growing a small account is not about being aggressive. It's about staying in the game long enough for compounding to work. 3. My Leaps framework for small accounts. Step 1. Pick the right type of stock. The first rule is, I don't buy Leaps on random names. I focus on companies with strong long-term demand, especially in themes like AI infrastructure, cloud chips, compute data centers, high-quality tech leaders, because Leaps are long duration. You want stocks with real long-term tailwinds, not short-term hype. Step 2. Choose the right contract. Deep ITM. This is the part that makes Leaps safer. If I'm buying Leaps, I prefer deep in the money calls because I want the option to act more like the stock. Here's the simple way to think about it. I want to pay for intrinsic value, not waste money on extra time premium. So I usually look for 12 to 24 months to expiration higher delta contracts, often around 0.70 plus if available, lower extrinsic percentage. This helps reduce the pain of chop and sideways markets. Step 3. Enter on pullbacks, not hype days. This is where most people mess up. They buy when price is up big and emotions are high. But with Leaps, I prefer to enter during pullbacks, market fear, volatility spikes, support zones, post-earnings dips, depending on the name. Because if you buy Leaps when fear is high, you often get better pricing and better risk to reward. And I want you to remember this. Leaps are made for patience, not for chasing. Step 4. Scale in instead of going all in. This is the rule that protects small accounts. I almost never buy full size in one entry. Instead, I scale like this. First entry, small. Add-on confirmation or deeper dip. Keep cash available. Treat cash like a position. This keeps me emotionally stable because I'm not stuck if the market pulls back again. Step 5. Have a simple exit plan. With Leaps, I always plan exits in advance. Because if you don't, emotions will do it for you. My exits are simple. If the thesis breaks, I exit. Not because price dipped 3%, but because the reason I bought it is no longer true. And on the upside, I like to trim into strength. Because trimming doesn't mean you don't believe. It means you're managing risk while still staying in the trade. 4. What compounding actually looks like. Here's the truth. Compounding is not glamorous. It's not about turning $100 into $10,000 in a month. It's about building the skill and discipline to repeat good decisions. Because as the account grows, a small win becomes meaningful. Your sizing becomes stronger and your emotions become calmer. The process doesn't change. Only the zeros change. 5. Quick example. Simple and realistic. Let's do a simple example. Say you have a small account and you buy one deep, ITM LEAPS on a quality stock during a pullback. You're not trying to triple it overnight. You're looking for a strong stock to recover over weeks and months. When it rallies, your delta helps you participate in that upside with less capital than shares. And if you scale correctly and trim correctly, you're building a pattern. Buy fear, hold structure, trim strength, repeat. That's the compounding strategy. So let me leave you with this. If you want to grow a small account with LEAPS, the goal is not excitement. The goal is survival plus structure. Pick strong companies, buy long duration, go deep in the money, enter on pullbacks, scale in, trim into strength, and let time do the heavy lifting. As always, this video reflects my personal investment framework and how I approach LEAPS as a long-term compounding strategy. It is not financial advice, just a transparent look into my process. If you see risks I may be overlooking, or you trade LEAPS differently, I'd love to hear your perspective in the comments. If this video helped you, make sure to like, subscribe, and I'll see you in the next one.